We're going to start with the market rally. The Dow surging for the second day in a row, now up a whopping 700 points in just 2 days. It's the biggest two-day rally since January, even as a trade tariff deadline with Mexico looms, but does it really? We might hear something about that. But despite the euphoria, there are signs of trouble. But is that good or bad? Safety stocks are soaring, with REITs and utilities leading the way. The 10-year yield remains near its lowest levels. And it gave back some ground today, the yield did, after that ADP report. Crude is collapsing, falling deeper into a bear market. So can you trust this market bounce? And what do you do right now, Guy Adami? I mean, I reference it. Sometimes trouble is good. You don't want people feeling too good about things, do you?
No, look at you. Sometimes trouble is good, right? A little acrimony sometimes. It gets the
I don't mean here. I don't like it here.
Keeps you on edge. Trouble.
I mean, you don't want people being too comfortable in their.
They are too complacent. I mean, I think Pete would agree with this. The VIX in this environment should be, in my opinion, should be closer to 21, 22 than to 17. So I think there is a latent complacency there because the last 10 years, every single dip in the market's been a buying opportunity, and you've been rewarded for buying the market and for being short volatility. I do think it's different this time. I do think yields going lower is a warning sign. I do think that utilities, XLU making all-time high in this environment is a warning sign. I do think that gold rallying is a warning sign. That being said, you can't discount the fact that the last 2 days has been very impressive. My inclination would be to fade this move.
Well, it's very impressive off of oversold conditions, and so we do this all the time. Is bad news bad news? Is bad news good news? Is good news bad news? And for the market right now, they are putting the Fed in play, and the market is saying that bad news is good news. Bad news, folks, is bad news. I think if we get 2 cuts this year, it is not augur well for not only S&P earnings, but the overall volatility environment. I think on Friday, you're going to get an opportunity with a payroll number, coupled with today's beige book that said everything looks actually quite fine, coupled with Fed comments from yesterday, to hear that good news will probably be bad news for the equity market, because I think equities have priced in way too much Fed here. I think the bond markets are way too far ahead as well, but it's equity markets I'd be more concerned about.
Let me push back for a second.
Sure.
Right?
Love it. We love acrimony.
Okay, we love pushback. All right. So when you're talking about the Fed, if the Fed cuts once or twice, that doesn't
make me feel good.
But let me ask you something. It's the same. So we have the same set of data, right? The economy. Would you rather have the Fed do nothing on it, or would you rather have the Fed cut on it? The data is what it is, right? The economy is doing whatever it's doing. I'd rather have the Fed. I know you think that's
great question. So
because things are cheaper, mortgages are cheaper. You know, having debt is cheaper.
I think, and if you look at what's been going on with APRs and credit cards, we're at 20-year highs in essentially revolving loans. But your question is a good one, which is, with the same data, wouldn't you rather have a lower rate environment? I'm telling you that I think the Fed's going to need to see worse data. The Fed's going to need to see continuing deterioration in the ISM, which we got 3-year lows, PMIs around the world, but most notably our data to cut twice, and that will be a bad environment. But all other things equal, with lower rates, you're right, it's good.
We got that print today on ADP, put the June Fed funds up 10% from last week, 33% for a June cut, 33% chance of a June cut. So I mean, 97%.
Well, Leisman was on with us today at noon, and he was talking about 3 cuts this year.
Right.
So, I mean, it's not, when I hear you saying 2, I'm thinking 2 doesn't sound that bad compared to the 3.
But it's not just dependent on bad news. It's dependent on good news on the inflation front. That's what everybody's missed this
What's
time.
good news? Good news is
good
inflation.
News is that inflation. Well, I don't know. I always thought low inflation was good news. But now it's bad news that it's too low, I guess.
Don't we have deflation? Isn't that a risk?
Disinflation. We're not going down.
Disinflation is not a bad thing. You're right. Deflation, look at Japan. Look at 30 years of trying to recover from a credit bubble. Guess what we had 10 years ago?
Right.
But where the response was that the central bank threw everything they could at the problem in terms of liquidity. I think deflation is a risk for the world.
Joe, I'm going to say something that I've said many, many times when we've been on this desk and we're down 500 points one day, we're down 300 points the next day, and we talk about algorithms, right? High-frequency trading, some of that stuff that's pushing the market around. Hey, I'm going to get out there right now and say, hey, it happens in these upward moves as well.
Right.
I mean, I think we're seeing algorithmic moves that are triggered off of words, whether it's the Fed, whether it's trade, whatever it might be, and that is why we're seeing these violent, even intraday moves. So to your point, the fact that volatility where we're trading right now, way too low. Way, way, way too low. A 16 VIX gives you a 1% move per day. Well, I can tell you, if you're looking at what we're doing per day, close to close is different. I'm talking about the movement we're getting right now. So because of that, we should be trading probably a 20, maybe 21, something like that. And so the fact that we're trading here in the 16s right now, I think it's a great opportunity to do something, Joe, where you protect your portfolio or you exit your stocks if they've performed well and you stock replacement with options in front of that. But either way, you've got to be owning options right now, mostly puts I'm talking about, spiders, whatever it is that might protect your portfolio, because you buy when you can, not when you have to. And in this market, we easily could see a VIX trading over 20 in a couple of days.
In a bull market, when you get a sharp break that's really scary and really quick,
yes,
that's usually the sign of a continuing bull market because it shakes people out. Is the same thing true in a down market? If you get a sharp move back up, can you trust it? That's what worries me. Is that it's the drip, drip, drip in a bear market that scares me, or the long-lasting bull markets. They go up a little at a time, and next thing you know, you're up 2 or 3.
I would also say we're looking at this trade market that we're talking about right now. It started off with China, but now just look around the world in terms of the tariffs that are being talked about everywhere. So this is no longer just a China trade war. This is becoming a bit of a war with everybody, potentially. And I don't mean that necessarily that we're not doing the right thing. All I'm saying is that changes the dynamic immensely to me. And that means you've got to put yourself in a position to be able to make money, because there are great opportunities. Every single day there are opportunities, but it's a trading environment. You have to scrunch down what your time frame is right now.
So I think if you look at where vol is, I agree with that. And ultimately, back to what Karen was saying, I think vol reflects a Fed put that's back in the market. But back to the market we had today and back to stock picking. I mean, look at how Apple's begun to decouple from the SMH. So Apple is actually basically considered to be a trade war stock, poster child #1. Actually has rallied 4% or so over the last couple of days. SMH was back down today. I think that's encouraging because ultimately, I don't think Apple should be tabbed directly to the semis and all the other cyclicals that are related to trade. So there's stuff you can do, Pete, out there in this market.
My biggest problem with Fed rate cuts, Larry Kudlow in early May said, the greatest, the president has said greatest economy in the history of the republic. It might be. I'm not arguing that. But if that is in fact the case, why are we even having conversations about Fed rate cuts? To me, it doesn't.
Why not have the pedal to the metal? Why not have the pedal to the metal if there's no inflation?
Why don't, I'll give you something novel. Why, when the rest of the world is trying to devalue their currency, why don't we do something novel like strengthen ours? Because it's in all of our best interests, including the people at home. Happening maybe for the wrong reasons. I know it sounds crazy, but the Fed's job isn't to save the market, it's to save the economy, and the two are much different things. I think we have an opportunity here in keeping rates the same or even raising rates to actually strengthen the foundation that's been weakened by 10 years of ridiculous
So we export
Fed.
Nothing and all we got a president.
What do we export? What, tell me what we...
Well, no, I'm saying if the dollar gets too strong, we've got a president that all he does is worry about trade deficits. You don't need a stronger dollar.
Well, I would think the consumers watching at home would disagree. I think a weak dollar is a tax that nobody ever sees. Everybody thinks it's great to have a weak dollar. The administration for decades has talked about that. Right. It's wrong. If you think
it's just right. 111 on the euro. I mean, didn't you think it'd be? I thought it'd be much higher.
I think if you buy things, you want your buying power to be stronger, and it's stronger if the dollar. Now, I know that's not great for multinationals, but it's great for the folks at home.
No, one thing I'd say real quick just is that if we're in such a great market the last couple of days, up 700 points, if it's so great out there, why are we seeing not just the utilities? How about the metals? I mean, when we see gold starting to make moves, we're seeing paper and silver every single day now. Different, either individual names or the ETF or whatever. You're starting to see the precious metals. People are jumping in there, Joe, and that's what I see. I see in the derivatives market.
You're saying you see it positive to the upside?
Well, I'm just seeing gold.
Buyers of silver and gold are people that are running scared.
Right. Yeah. Exactly right. Doesn't mean they're right.
Because oil should be going too if it's inflationary.
And meanwhile, oil's not. It's going the wrong way. Yes.
So and in fact, so to dovetail that, Joe, if you look at the steel companies again, they were back on the sell side. If you look at a lot of the materials companies, I say this all the time, not because I think they're a bad company, but look at Glencore stock if you want to understand some of the pricing pressure, some of the leverage pressure, and some of the impact of the global commodities industry, because they're probably the biggest and the best commodities trader out there. That stock's been on the skids now for really 6 months, and I think until you start to see that improve, I'm not in there buying commodities wholesale.
Did you people actually trade things today? They told me to ask you if you would. What did you do?
I did not.
You did not.
I did not.
I haven't traded things in 26 years, so I can't.
Well, you would today?
I'm not allowed. I'm not allowed.
You can do spiders? I guess you could do
ETFs. I guess I could do ETFs.
You can do all
I guess I could do
that.
ETFs, but I'm morally opposed to those.
One of the things I did a couple of days ago was got exposure actually to what I think are going to be bond yields that begin to normalize a little bit more off these levels. So I've been owning both calls and some spreads in the TBT. which to me is, again, the opposite of your view on Treasuries rallying, actually, that they're going to sell off in long end. I just think we have to reconcile bond markets that are screaming something that I'm not sure the Fed really thinks is taking place.
Joe, I'll tell you, I've done quite a bit of trading in the last 2 or 3 or 4 days, and it's been because of the fact that I'm seeing all these short-term type things. I'll give you a great example. GLD, monstrous buyers just last week. I'm already out of that trade. GDXJ, which is the miners, junior miners, that gives you a little extra torque, so I bought into that one. I don't know if everybody knows that they're the junior miners, but, and they move a little bit faster than GDX. But Dropbox is another one. But everything I'm seeing, and I've been saying this since the start of the year, everything that we're seeing does not go out more than 2 months. I mean, so everything is short term, everything seems like it's tradable, and there's not a whole lot of investing going on out there.